It's time for Wall Street Beat. We're going to take a look at what's buzzing on Wall Street and the world of banking and finance. Sonali Basak joins us with more. What were some of your takeaways of that, Sonali?
Well, it's interesting to hear him talk about the public market dynamic because, of course, we know that a lot of activity in equity markets and fixed income markets have been moving to private. This has certainly been the year of private credit. The pitch Apollo makes here is that it's not necessarily riskier to be illiquid. Whether that will be true or not will be sought out over time. It's interesting to watch. This is a period of time where default rates are expected to pick up next year in the private credit markets. Now, can a firm like Apollo and its rivals start to sidestep those problems? Interestingly enough, when you think about private, when you think about Apollo used to be known as this big distress player, but really they're looking at kind of single B and safer credits in private markets now, particularly as the banks have stepped back, which begs the question, as things start to get rough, will you start to see Apollo still dive in to any of those riskier names, given that there will be rescue financing needs into next year?
One of the reasons why people perceive private markets to be more risky is there's less regulation. Is that regulation coming, and does that even the scales?
It begs the question, doesn't it? We have a day ahead of the bank CEOs taking to Washington, and you have the bank CEOs saying, hey, listen, the more you squeeze us, the activity is moving out of us into these non-banks. Now, the non-banks get their money not from depositors, right? But what's interesting is Apollo, KKR now, you see them increasingly getting money from insurance companies. And these are not traditional insurance companies. These are annuity companies, which are retirement providers, which look a little bit more like a bank than a typical insurance contract for your auto insurance would look like. Do they get more regulation? They already do have state-by-state regulation, but what about the products they invest in? That's a big open question. Will the Financial Stability Oversight Council start to broaden their reach away from the banks into the non-banks more? You could make an argument here that Apollo, for example, is less than $1 trillion in assets, while a BlackRock is trillions in assets. So what is a non-bank, and who are the regulators going to be more concerned about more immediately?
I mean, here's kind of a dumb question. I mean, I can withdraw my funds at a Citibank no matter what at any time, right? If I lock my money up with Apollo, that's like a 10-year thing, right? I mean, isn't that the whole thing about a time frame that they're going to sort of front?
Well, the time frame is why they believe they could take these more illiquid bets than your average investor could. But you have to think about where the money is coming from. One source is those insurance companies, like I was saying, but now increasingly and interestingly, those sources are also coming from high net worth individuals. So Blackstone, KKR, Apollo, they're all looking at high net worth investors, going to banks and brokerages to lock individual investor money up for longer periods of time, and then they're co-investing alongside these big sovereign wealth funds and pension funds. So yes, the money is longer dated. The question is, how long is that money dated for?
And the calendar still runs out, like, you know.
Eventually the calendar does run out, absolutely.
For all of us. On that cheerful note. Sonali, talk me through tomorrow. We've got bank CEOs coming up. Often there's political theatre here, but where's the signal going to be in the noise tomorrow?
I think we're going to talk about this more, Guy, but for starters here, you have to know from the side of the banks, the big push is to convince the lawmakers that the new rules that are coming up are way too stringent. We were talking to the head of the CEO of the Financial Services Forum later on today, who has already put a note out saying that this will impact America because when these banks are constrained more than they have been this year, that this will be a problem in lending markets. Now, what will the lawmakers have in return? Of course, they're going to be upset about a whole bunch of other things, including the constrained lending we've seen, particularly in mortgage markets. Certainly a lot to look forward to. Hours of grilling ahead. Of course, this has been multiple years of annual grillings for these CEOs. But of course, this non-bank versus big bank dynamic is a fascinating one. Remember, a lot of this movement into the non-banks happened in the wake of the last financial crisis. You have to expect that if you tighten the reins more on the big guys, that more activity moves out of the system into the next decade.